So short selling occurs when an investor borrows a security and sells it in the open market, planning to buy it back later for less money. And I'm going to show you how to do this on E-Trade and then try to explain a little more in depth about it, because it might sound a little confusing at first. So short sellers bet on a stock going down and make money when it does go down, but they lose money when it goes up. And that's the difference between longing and shorting. When you long, you just buy the stock and you hope it goes up. But when you short, you hope it goes down. The reason short selling is so risky is because if you think about on the other side of things, when you buy a stock, say for $100, you may lose $100. That's all you can lose at most. But when you short a stock, the price can go up to infinity, so you can lose a lot more than $100. Let's actually short a stock in E-Trade. This is my current portfolio in E-Trade, and I took all the cash out and put it into another account so I can convey the message on this video. There's no cash, and I took a screenshot of this and put it into my Excel file so I could show you what it looks like, my account, after I short a stock. I don't like shorting stock because I have to use margin, and when you use margin, you have to pay an interest rate on the money you borrow. So I'm going to short Tesla, so I'll just go up here and type Tesla's stock symbol and then select it, and then I can just hit the sell button. This is the same screen as when I want to buy a stock. So I could go to this drop down and it has the buy in it or sell, but it also has these two other options. And these might not be on your E-Trade unless you got approval. And I'm going to sell short. I'm just going to sell short one share of Tesla, just to show you how it works. And I'm going to select one in the quantity, and I'm going to select market order so the transaction happens immediately. And it's nice to see I don't have to pay a commission when I do this. So you see it says my estimated proceeds are $1,000. So I'm going to receive $1,000. If I was going to buy the stock, it says my estimated cost. So I would lose $1,000. $1,000 would be taken out of my account, and I would receive one share of Tesla stock. But when I sell short, I actually receive $1,082 in cash into my account. And then when I hit the preview button, I can just take a look at it to make sure I entered everything correctly. Sell short, one share, Tesla, market order, it all looks good. And that's the estimated proceeds, $1,083. So I'm going to place the order, and it happened automatically. So I'm going to go to my portfolio. E-Trade deposited $1,000 into my account in cash. So I have one share of Tesla at negative $1,079. You see the quantity is -1. So I owe one share. That's why it's negative. And I'm hoping the negative goes down. So if the stock price of Tesla goes down, say it goes down to 500, that would bring it down to a -500 in my account. And that's good for me. But if the price of stock goes up to 1,200, that would be a higher negative, and it would be -1,200 in my account, which is bad for me. And the difference between the cash amount, the $1,083, and the $1,079 is the $4 I made on Tesla. Since I bought the stock, it has gone down $4. So I made $4. And people short stocks also to hedge themselves. If they have a lot of risk in the market, they may short stocks because it would balance out their trades. It is a risky proposition. You really need to know what you're doing. So some of my stocks did change in value before and after. Silver was 126,230, and now it's 126,107. So you can't just look at Tesla and expect that to be the only difference. But you can see I have no cash before the Tesla trade. Now I have $1,000 in cash, and they added the one Tesla trade to my account. So let's bring it back to the beginning. So the process is pretty simple, and you don't actually have to do anything. E-Trade does everything, or your broker. So in my case, E-Trade borrowed Tesla stock from somebody in the market, and that person may not even know their stock is being borrowed because they still see it in their account. What E-Trade did was they took one Tesla stock out of somebody's account and they put it into my account. So that's step 2. E-Trade put 1 share of Tesla in my portfolio. Then to step 3, E-Trade sold my Tesla stock to somebody in the market who's looking to buy Tesla. And then they received cash from that sale. They deposited that cash into my portfolio. That's why you see cash. And in order to record it on E-Trade, so they know what is borrowed and what's not, they put this -1 here on my account so they can keep track of it. And that's my cash to use. I can use it to buy stock. I could take it out and buy lunch with it, whatever I want. It's my money. And now step 4 is I owe E-Trade 1 share of Tesla plus interest on the loan they provided me. I'll talk about the loan in a little bit, but let's talk about the fact that I owe E-Trade 1 share. So I do owe E-Trade 1 share of stock. So at any point, even right now, I can just go to buy to cover 1 share at the market. So the cost of this trade is $1,080. So that's how much will be taken out of my account if I do this trade. So I can preview it. I'm not going to actually run the trade, but that's what I would have to do in order to give my Tesla share back to E-Trade, because I still do owe E-Trade 1 share of Tesla. And it's not just my decision on when I give it back. It probably is my decision, but at any point, E-Trade may force me to give them the Tesla share back. To give you an example why E-Trade may force me to replace the share I borrowed. So just remember, I owe E-Trade 1 share of Tesla. And I borrowed a share of Tesla and sold it in the market at this point. So I need to replace the share I borrowed. If Tesla was trading today at $1,000 and tomorrow at $100, then I could just go into the market and buy 1 share of Tesla for $100 and replace the share I borrowed through E-Trade, and I'd be done and I'd make $900. But what if tomorrow Tesla was $10,000? Now I have to go into the market and buy a share for $10,000 to replace the one I borrowed. That's expensive. I could wait for the stock to come down in price, but it could just keep going higher and higher, and then I might be bankrupt. So if E-Trade doesn't feel I'll be able to pay back the borrowed stock, meaning I can't afford the $10,000, they may force me to sell. So if my portfolio had $50,000 in it, E-Trade probably wouldn't force me to buy the stock for $10,000 because they feel pretty comfortable I can afford $10,000. But what if my portfolio was only $2,000? Then E-Trade would probably force me to replace the borrowed stock because they don't feel I'll be able to afford the $10,000 and definitely not be able to afford it if it keeps going higher and higher. So I'd have to find money through other means, like my retirement, or I'd have to sell something in order to come up with $10,000 to replace this borrowed stock. To add more confusion to the whole situation, you have to use margin during this whole process. When you short a stock, you have to do it on margin, which means you have to take a loan from your broker. So in this situation, I had to actually borrow money from E-Trade. I'm just using $1,000 to keep everything simple. I know Tesla stock is a little more than $1,000. So in this situation, I had to actually borrow $1,000 from E-Trade and pay interest on that borrowing. So if I kept the stock just, for instance, 48 days, I would have to pay $11 in fees to E-Trade for borrowing that money. So E-Trade charges about 9% annually to borrow on margin. So if you break that down by day, it comes out to about 0.02%. So this number is how many days I would borrow. So if I borrowed the whole year, it would be 8.95%. But if I only borrowed for 30 days, I would have to only pay 0.74%. So if I kept this Tesla stock in my portfolio for 60 days and then replaced the stock, I would have to pay 1.5% of interest fees to E-Trade for borrowing the money. So if the stock went down 1.5%, I would just break even on the whole transaction. I would make 1.5% on my trade, but I would lose 1.5% on the fees to each trade. So it's so risky when you do this, because not only do you have to be right on the trade, but you can't take forever. So if you waited 2 years for your stock just to break even, you would lose 18% on the margin. So margin adds even more to your risk because you have to pay all these fees to your broker. So let me know if you have any questions about margin. I know it seemed like a lot in one video, but I hope you learned something. Thanks for watching.